The economy seemed to be at the top line doing okay. It was before the election, despite the 10% correction in stocks and all of the hand-wringing that we might be having a recession now. I do think it's still okay, but I think there's an important distinction about the top line being okay. It's what economists call K-shaped, right? That the bottom half of income is not doing as well relative. Now, of course, to the bottom half of income, I don't expect them to do as well as the top half, but you can measure it on a relative basis. What's been the big difference between the two? Inflation. That the inflation rate has taken prices since the beginning of 2020, I'm going with the end of COVID, to now up about 25%. So if you haven't gotten a 25% raise, you haven't kept up with inflation. 54% of the public, according to a bankrate.com survey, says they cannot come up with $1,000 in an emergency. So if their hot water heater breaks or their car stops starting, they have to borrow the money on a credit card or from a friend. Those people usually rent and they have no assets. So they're dependent on them getting a raise to keep up with the cost of living. And largely for the last 5 years, they have not gotten that. I could actually say the same thing about the top half of income, right? That they need their salaries to go up in order to keep up with inflation. But maybe at the top half of income, even though they make more money, that hasn't happened. But three big things. One, they have a lot more disposable income because they're in the top half of income. So they have extra money to spend. Two, Redfin or Zillow tells them their home, which they own, goes up in price. And three, they own a portfolio of something, crypto, stocks, something, that's gone up in price too. So as I like to say, the biggest difference between the bottom half of income in this environment now and the top half of income is they go to the grocery store to buy some eggs, and the bottom half of income says, well, if I'm going to buy these eggs, I can't buy something else. And they have a 4-letter word that they mutter under their breath because of the decision they have to make. Top half of income goes to the store, sees the price of eggs, mutters that same 4-letter word, and then they just buy it and move on with their life. And they don't have to make another hard choice along the way. And so that's the biggest difference in the economy. And that is important to really discuss what's going on, because the bottom half of income cannot come up with $1,000 in the savings. They put Trump in the White House and they are demanding something in return for that. And by the way, that demand is not another 20% in the S&P because they don't own it. That demand is they want their jobs back. They want their lifestyles back. They want prices to come down so that they can afford the necessities of life. And that seems to be a big driver behind, I think, the Trump administration's policies that we've seen over the last 2 months. What we're talking about is a recent Fed study came out that the top 10% of income, 10% of the public, accounts for 50% of retail sales. So that half of all the spending in the country comes from 10% of the people. And that's the most concentrated it's ever been. And that's because of years and years of asset price appreciation that has basically papered over a lot of the ills that we've had. And it's also created the partisanship in this economy and, the difference with the K-shape. The detox that he's talking about is, why did the top 10% get so wealthy? Money printing, zero interest rates, accommodative policies, all designed to push up asset prices. The problem with that is it's put us in debt, it's given us the big deficits, and it's given us a lot of other problems that we've had. And that's what we have to detox ourselves from in order to get this economy back. Now, they have shifted their focus to the 10-year yield, that they define the successful policies, 10-year yield falling as opposed to the S&P going up. That's part of the same thing, that they're not just trying to cater to the wealthy. So what is it that is underlying driving all of this? And that is a simple question. Going into the election, were we on the precipice of a crisis? A crisis of, we have too much debt. We have too much borrowing. The dollar is in a precarious position. Chairman Powell in December gave a speech and said the fiscal situation in the United States was unsustainable and said we had to change it. So the Trump administration comes in and says the status quo cannot hold. We cannot keep doing this. We have to try something different. So there's trying something different is involving tariffs, trying to bring down the value of the dollar against our trade partners in order to make, say, manufacturing, heavy industry jobs more competitive, trying to get more of those. And look, it may not work, but I understand what they're trying to do. We have $36 trillion of debt. Where did all that debt come from? Maybe the last 70 years fighting communism and then terrorism and protecting the free world and keeping the shipping lanes open while Europe, South Korea, Japan has not had to pay for any of that. And now that maybe the bill is due, that it's time that they step up and start paying for this. That's why this demand that there be defense spending in Europe, this Mar-a-Lago Accord about swapping debt for treasuries, this idea that's just a payment mechanism has come along because the status quo can't hold. So let me conclude with this idea. A week ago, cover story of The Economist magazine was a picture of Trump with a can of gasoline and a lit dollar bill about to set the world on fire. And I would argue that if Trump were to come out during our recording and say, you know what, I've had a change of heart. I'm done with tariffs. We're done with that. We're not going to talk about it anymore. I just fired Elon and Doge. They're out the door. We'll go back to $7 trillion budgets, $2 trillion deficits. Here's a blank check for the Ukraine. Whatever they need to fight Russia, we'll just give it to them, open-ended. What would be the response? That was where we were 4 months ago. I think the bond market would collapse on that news. You're going to borrow astronomical sums of money. We're going to drive interest rates through the ceiling, and that would prevent stocks and crypto and everything else from rallying. So the argument is there is no going back. We have to move forward with these big realignments we're doing. You could criticize Trump, and I have my criticisms about a lot of the things he's doing, but then you have to say what it is we would do in place of this, because always the criticism is this policy's bad. Just stop. Just do what we were doing 6 months ago and we'll be better. I'm not so sure that's the case anymore. We can't just stop doing this and just go back to giant deficits and, rampant government spending and all of the other problems that we've had and just burrow into infinity. So that's where we're at right now. We're in a major realignment is where we're at. And then finally, when we need to pay off this debt, where are we going to get the money to pay this? Now, the typical answer is we got to tax the rich. We've been trying that for 60 years, and that's how we got to this point. And the rich don't have enough money, but there is a bigger pile of money than the rich in the United States. It's everybody else in the world. And that's what this whole defense spending is. You, Europe, you, Japan, you, South Korea, you're going to pay this. And we're going to give you a bill for security to pay this. And that's not different than what we've seen major powers do throughout human history. Whenever they get over indebted and they get into trouble, they usually invade their neighbors and plunder them. Well, we're not invading anybody. We're not plundering anybody. We're doing the 2025 version. We're sending them a bill. We're saying, here's a bill, pay it. And so that's where the money is to get us out from underneath this debt problem. It's in Europe. It's in Japan. It's in South Korea. It's in Mexico. It's in Canada. And that seems to be the policy that we seem to be going for. So I understand why the Economist magazine's hopping mad. I understand why they're seething about us in Europe, because we're asking them to do something that they've never had to do before. I have been one that argues that we're in a long-term bond bear market. And the immediate response is, oh, well, then get your money, run away from bonds as quickly as possible. Yes, but now that we actually have a coupon yield, and I'm talking about all in, mortgages, corporates, treasuries, and the like, of around 5%, the bond market can return you something around 5% in a bear market. Some of the years you will have prices go down. So you might get your 5% coupon and maybe a 2% or 3% loss, and you have a 2% return. That was last year. But then the coupon might go to 6 or go to 5.5. And then the next year you get a bigger coupon and prices might go up and you might get some capital gain. So you might get a 2% return one year, an 8% return the next year, and you'll average about 5 over a long period of time. And that, I've argued, is a very attractive investment. Why? Because if you look at stocks, well, stocks go up 20% all the time. And, and AI and everything else is driving, the Mag 7 is driving all this stuff up. Yes, but now we've gotten stocks to such an overvalued level that historically, from these levels of PE ratios and market cap to GDP, Shiller-Cape ratio, whatever is your favorite metric, you should be looking at long-term returns over the next several years. The stock market will return you about 6%, maybe 7%. Now I'm talking about like the S&P 500. Bonds are going to return you 5%. With less volatility, a bad year will be +2, a good year will be +8, and they'll average 5. Stocks will return you 6 or 7, but a bad year might be -10 or 15. A good year might be +25, but they're only going to return you 6 or 7, I think, is where we are. So in the bond market, what I'm trying to say is that coupon matters. Now, 4 years ago, the coupon was 0 in the bond market, and we had to go from 1 to 5, and that was horrible for bond investors. But now that that's behind us and we're at 5%, that yield in the bond market is very good. I think in the next several years, just buy VOO, which is the Vanguard S&P 500, or SPY, buy the S&P 500, buy your triple Qs. There you go, you're done. That might not be very fulfilling, because especially the Mag 7 stocks are so overvalued, they could correct and the indexes might do nuts. But there might be opportunities in European stocks, small cap, maybe in financials, healthcare, energy, maybe in active management. That's a little bit difficult. That's a little bit of a different skill set. And if you did that right, you can actually earn a little bit more. But problem is, nobody does that anymore. The stock market is two stocks. It's SPY and it's QQQ. And what I'm saying is, it's not going to be terrible. There's going to be opportunities, but it's not going to be SPY and QQQ. It's going to be other things. And there's thousands of ETFs out there that you can take advantage of those other opportunities. And I can envision a period in the future where people are back to talking tickers again. We have had a need to talk tickers for a long time because it was the only ticker was SPY. The only ticker was triple Q that we had to talk about. And the bond market will be at 5% with low volatility. It's basically going to give you most of the stock market's returns with less volatility. It's a very different animal than it was when we used to scream Tina. There was no alternative. Everybody had to get in the stocks. There is an alternative now. The key is there's a coupon. There's a 5% yield that it's going to churn out year in and year out. And that has changed the dynamic of the bond market a lot.